Taiwan Semiconductor posted the biggest profit in its history. Net income up 77% from a year ago. The first quarter ever above 700 billion Taiwan dollars. That's really magnificent, and roughly 63 billion of it came from selling a stake in another company, not from making a single chip. So the record is real. The number you will see in every headline is just wearing a little more makeup than it needs to. I am Vikas, your host. This is What Changed from Wing. We don't chase headlines, we explain what changed. Three lines. Uh, TSMC's profit jumped 77% to a record. The reality is, stripped out a one time gain from selling part of Vanguard International Semiconductor, and profit still grew about 64% because the foundry itself beat its own guidance and every line. So, this is a genuinely excellent quarter for Taiwan Semiconductor. It just didn't need the one off it came with, and the market spent the day looking past the records at the bill behind it. Let's work the profit numbers because there are really two of them hiding inside one. Here is the way I would think about it. Imagine someone with a steady salary every month, roughly the same paycheck lands. That's the income you can count on again next month. Now imagine that this particular month they also sold their car. Suddenly, the total money that hit their account is way up. Both numbers are real, but only one of them tells you what next month's look like. The salary is the business. The car sale is one time event. For TSMC this quarter, the salary, the actual foundry is operating income. And operating income grew 65% from a year ago. That's the chips. That's the factories running, the price, the demand, and it is very clean. The car sale is the Vanguard stake. Back in May, TSMC sold about 8% of a company called Vanguard International Semiconductor and revalued the shares it kept. That produced a gain of roughly 63 billion Taiwan dollars, about 2 billion US dollars. And here is the number that matters. That single item was about 94% of the entire jump in what's called non operating income, nearly all of it. It also made up close to half of the profit increase from just the previous quarter. So when you hear profit up 77%, what you are actually hearing is the salary up 65 plus the car sale on top. Take the car sale back out and profit still grew about 64% year on year, which is spectacular. Nobody should walk away thinking this was a soft quarter. The point is um, small, and next quarter there is no car sale. It is very uh, it this is this quarter the car sale or the company sale matters more because it is more than 90% of this operative income. So the honest number to carry forward is the 65% operating line, not the 77% headlines. And the operations genuinely earned their applause. Gross margin came in at 67.7%, above the top of the range management had guided. Operating margin hit 60.3%, beating the guided ceiling by almost 2 full points. That was arguably the single most impressive figure in the whole release, not the record profit, but how much of the revenue is turning into operating income. The other thing that changed quietly is the technology. 2 nanometer, TSMC's newest, most advanced manufacturing process, just booked its first ever revenue. It went from 0 to 3% of wafer revenue in a single quarter. Combined with the 3 nanometer node, the two most advanced processors are already a third of wafer revenue. Now, inventory also jumped this quarter, and normally rising inventory makes you nervous because it can mean products are not selling. But management told us exactly why it rose. They are building wafers for the 2 nanometer ramp. That's not weakness. That's the pipeline for next year filling up on schedule. Here is why all of this matters beyond one quarter. TSMC did something this quarter that companies don't do casually. It raised its guidance for the entire year. Back in April, management said full year revenue would grow above 30% in US dollars. This quarter, they moved that to slightly above 40%. That's the second raise this year. And you do not raise the year twice into softening demand. That upgrade is management's clearest possible signal that the artificial intelligence built out the supply is still accelerating. Which connects to shift I want to flag. TSMC is quietly becoming an AI company with a phone business on the side, the high performance computing platform, that's the AI and data center chips, and climbing to 66% of revenue this quarter, up from 60% a year ago. And also, the smartphones dropped to 22%. The company that was famous for a broad, diversified customer base is now, by revenue, increasingly pointed at one end market. That concentration is why revenue is compounding so fast. It's also the whole risk in one sentence. The thesis now rides on hyperscaler AI spending not blinking. And now the counterintuitive part, the thing that surprises people. This was a record quarter on almost every measure, and yet the market reaction was cautious, even negative. Why would an excellent quarter get a cool reception? Because the same quarter arrived with a record bill. Management raised full year capital spending to somewhere between 60 and 64 billion US dollars, an all-time high. And the finance chief said the next 3 years of spending will run significantly higher than the past. You can already see the strain. Free cash flow actually fell about 18% from the previous quarter, even though operating cash flow hit a record. The spending simply outran the incoming cash. So the debate around this stock is not, was the quarter good? Everyone agrees it was. The debate is whether the price of the stock and the enormous factory bill now arriving with the AI boom are justified by even this level of demand. That's a very different and much healthier argument to be having. One more honest note, and it's the kind of thing we always flag. Next quarter, management guided gross margin lower to between 65 and 67%, below the 67.7 they just delivered. Not because anything's wrong, but because newer overseas factories dilute the margin as they ramp. Bigger businesses, slightly thinner margin on the next dollar. Both true at once. So, where does that leave our conviction? Last quarter, this scored 7.4 out of 10. Today, that moves up to 8.1 out of 10. It rises because of the durable operating strength is real, and management backed it by rising the whole year. So it doesn't spike because the same strength justifies a record spending bill, and the stock already carries a lot of optimism. Execution is not the question here. The price of that execution and the AI demand underwriting it, that is the question. And to be clear about what that number is, uh, it's not a buy or sell recommendation, just our assessment of how much confidence today's evidence deserves. Three things the next quarter will answer. Number one, with no stake sale to lap, does operating income hold its 65% pace? That's the real run rate. Watch it, not the headlines. Number two, how steep is the 2 nanometer ramp? 3% was the debut. The slope from here is the growth engine for the year after. Number three, how wide does that gap run between that 60 to 64 billion dollar spending bill and free cash flow? That gap, the price of the AI build out, is what the market is really watching now. So the real story of the quarter is not the profit up 77%. It's that the foundry grew 65% all on its own, raised the year, and started shipping its newest chip. And the only real question left is whether the price and the factory bill are worth it. If you would like to explore every source calculation behind today's analysis, you will find the complete research report at VYNG.io. Everything is sourced directly from TSMC's filing because trust isn't built by confidence, it's built by transparency. I'm Vikas. This has been What Changed from Wing. We don't report everything, we report what changed. Clarity, not clutter.